Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, the way you described Christmas weekend was kind of a planes, trains, automobiles scramble. Did you get to relax a little to ring in the new year?
Actually, yeah, I was very looking forward to staying at home. We were actually at the office pretty much every day over the weekend. That's when my wife gets a lot of the work. She does a lot of the hands-on stuff.
That isn't exactly what I meant by relaxing at home for the new year.
Well, you know, when there's not so many people here, and we have several employees that come in and out and work on the weekends occasionally, but over the holiday weekend, you don't expect to see many. We had a couple, but it is actually relaxing. I get a lot of work done when there's nobody in the building, and my wife is, you know, she had to take down all the Christmas decorations this past week, and so she was just getting stuff rearranged and prepared for that. And we were actually getting ready. We had to move a lot of furniture. We were preparing for something exciting. We're building a brand new studio in-house, and construction is going to be starting on that, I believe, next week. So we were having to get some stuff moved around. So I'm really excited what that studio is going to turn out to be. Right now, you and I are in a studio we have right off our lobby, but it's a little small, and we're kind of stepping up big time. So that's going to be exciting, the new studio. So we'll see.
Well, we have both feet firmly planted in the new year here at Retire Smart. The new studio is coming. And David, the 2024 rotation of informational classes fires up this coming week. I didn't realize this until you mentioned it. We're going to have more than 80 of these classes over the course of the year.
Well, they've just become so popular, and the great news is we keep scaling out and building our team. So the various resident authorities we have on all these different topics, and you know we have you know, basically about a dozen licensed advisors sitting down this hall here, and each one of them has stepped up over the time to kind of become, you know, the lead person, if you will, on subject matter. So that because we, as we always talk about, we do everything as a team. You don't have one advisor; you have an entire team of advisors and support staff that serve our clients, and so they're able to go to each other. Like, we're going to have Sean in here shortly, and Sean's our go-to authority, if you will, for the Social Security, and so the advisors will often ask him, and we have a way to communicate, inter-office communication, and it helps other advisors learn things, especially some of our younger talent that we have in the building. We'd featured Alex here recently on the show, and he actually works really closely with Sean, and so he's just talked about how much he's learned from Sean. So I love that we have this iron sharpens iron mentality, and these classes help us keep our public sharpening up on their financial literacy, because as you hear me complain about it, we just don't teach it in our country. From elementary school to high school, which it should be required, there are some basic courses now, but in college, I mean, even doctors, dentists, lawyers, I always ask them. My brother went to law school. It's like, well, what year did they teach you the accounting of a business? But yet most lawyers go out and hang a shingle and open a business and have no idea all the pitfalls and the taxation. Anyway, so the classes have just become a home run, and it's been really well received to the community. So we stepped up and added quite a few this year. We've more than doubled our course load.
Well, we kick it off this week with Smart Social Security Blueprint. Financial advisor Sean Swanson will join David in the second segment of this show to talk about it in more detail. We'd love to see you there. All right, David, I'm gonna throw a devil's advocate question at you, because I'm seeing and reading a lot of commentary from voices out there in the financial industry saying, well, you know, there are a lot of Chicken Littles running around claiming doom and gloom, and we had a nice market rally at the end of the year, and things are looking pretty good economically. David, are you starting to worry that you're looking like one of those Chicken Littles on the economic forecast?
No, because if you take out the Magnificent Seven, the market did, you know, it went up last year, but the economy, the underlying fundamentals are not only they're not good, they're deteriorating, and then it's accelerating. And we saw some tax selling right out of the gate the first couple of days this year. People taking the gains in those high flyers that they had them and sold them, and the NASDAQ was down 3% the first day of the year, you know, tech stocks, et cetera. So I don't think Chicken Little, you know, I don't take to that at all. I think we're spot on with our call on the economy, where we're going, and I think you're going to start to see mounting job losses. I've been talking about this the last piece of the puzzle that usually falls before we enter some form of recession. Now, do I think we'll go through it? Absolutely. We innovate our ways, you know, through tough times all the time, and we will survive this next recession. But it's coming, and there's nothing you can do to stop it at this time.
Well, right before we walked into the studio to record this show, you hit me with this. We have now hit 30 $4 trillion in national debt. And there's a little graphic here from the P. Peterson Foundation that says this is roughly the value of the economies of China, Germany, Japan, India, United Kingdom combined.
Yeah, take all those nations, combine their entire GDP, and we owe that much in debt. Now, we talked about what, Chip, it's up to, and this happened earlier this week. This happened at about 2 a.m. Wednesday morning, our time, is when it rolled over, and it's accelerating. By the end of this year, and we made a prediction last year, it'd be $1 trillion. We're at $1.1 trillion today, Chip, to service the interest on our debt. That's $250 billion more than we spend on defense or Medicaid. Okay, Medicare is still in front, and Social Security is still in front, but we're going to eclipse it. This will become the number one budget item when it passes $1.35 trillion, which it will do by the end of this year. This is scary times, and if we don't get some big boys to wake up, all you need to do is look at countries. Look at Zimbabwe, okay, a little bit older example. Look at Venezuela, right? These examples of countries that thought they could print their way out of these, excessive spending or government programs. Keynesian economics do not work, and it's high time we get some big boys, some realists in the room to start making better decisions. We have nothing but academias that have never run anything, never been in the real world making decisions. And this is the future of your great-grandchildren we are now talking about to pay these debts back off. It's sad times. It really is. But can we get out of it? Yes. But we've got to get people elected that will actually move the needle. So, and that includes Republicans, Democrats. We need some fresh blood, in my opinion, throughout Congress, et cetera.
David, you were talking about the jobs piece of the overall economic analysis. I'm going to hit you with the good, the bad, and the ugly here. All right. The first, the good, this is CNBC. Salesforce shares jump on better than expected earnings report. Although, as you pointed out, more revenue is good, but where exactly did it come from? Not necessarily from more sales.
Yeah, so Salesforce had great earnings at their most recent report, but they actually had less customers. And so that's a concerning sign for the economy. And Salesforce, if you're not aware, they have software that is basically a CRM. Almost every business has a customer relationship management software. We have one. We do not use Salesforce, full disclosure, but it's the biggest and baddest out there, so to speak. But it's a subscription-based model, so they have a wonderful business model. Once a business loads in all their data and uses it to help them communicate with their clients via emails and text or whatever it is, it's kind of hard to get away from a system like that. So they have a unique business model, and as they add businesses, and they have pricing power, and we've had inflationary prices, so that's how they hit this record revenue is inflation, but they actually had less customers. That is a scary sign for a company that's subscription based and the best in their industry, and that's by a wide margin. That's telling you a sign of, okay, there's probably less new companies making it or forming or, willing to pay for these type of services. So that's a concern.
Is that a manifestation of inflation? Is it they're charging more for their subscriptions?
Absolutely.
So that's why they're making more money?
Yeah, it's a tech company, so they pay coders to behind the scenes, et cetera, and they have consultants and salespeople. And so if the salespeople aren't closing more deals, then obviously the revenue growth will slow. And so that's just, something to be of concern. But anyway, it was good earnings, but on the other side of that, we got to go to UPS, right? The package delivery, and we talk about all these inflationary deals with the wage deals and we talked about it. A UPS truck driver that's tenured making an average like $160,000 or $170,000 a year now. Well, here comes some layoffs, right? So
Economics 101.
Yeah, and so they're basically laying off a ton of people here coming up February 1st or so, thereabouts. I forget the date in the article I sent you, but in Louisville, big central hub, and they're going to more automation. And so that's the problem, is we're going to see more job cuts come down the line.
So Salesforce was the good. That was the bad news for UPS in Louisville. And now here comes the ugly. This is, I'll read the headline. Banks axe 60,000 jobs in one of worst years for cuts since financial crisis. David, we're talking global banks, major banks, Wall Street banks. And I keep coming back to an exchange we had early last year I said, well, David, are we having a slow motion financial banking crisis? You said it's not slow motion. It's rather stealth. People are keeping it quiet. But no, well, now the rubber meets the road here.
Yeah, the amount of net withdrawals from commercial banks in the U.S. was over $1 trillion last year. So $1 trillion is taken out of the deposits. So if you don't understand how a bank works, it's real simple, right? They pay you on your deposit so they can have money in the bank, and then they loan that out to consumers on credit cards, car loans, house loans, business loans, et cetera, at a higher rate. They make a net margin spread, but they need the deposits, Chip, to be able to make the loans. Well, if $1 trillion plus disappeared in deposits in 1 year, and just so you know, they get about a 9-to-1 ratio, that's $9 trillion in loans that bank can't make, or those banks can't collectively make this year. That's a huge hit to the economy. And if banks aren't growing, the economy is usually not either. And so this is a telltale sign. 60,000 jobs, and we're not done. We talked about recently the Citigroup, one of the 4 largest banks in the U.S., laying off over 15% of their entire staff. So expect more of the hits to come. We've even heard rumblings here of First National Bank cutting over 10% of their staff. So, this is a sign when the banks are cutting back. That usually means economic shrinkage, contraction, not expansion.
Don't panic, but don't be complacent. Get the complimentary report card, 402-369-7777. There's no charge, there's no obligation. We'll review your whole financial situation. Maybe you're in good shape. Maybe you need to make some changes. We'll offer recommendations for what you might want to do going forward. The complimentary report card, 402-369-7777. 402-369-7777. Up next, we have another round of Social Security classes coming up. That means it's time to check in with financial advisor Sean Swanson. He's up next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Smart Social Security Blueprint is one of our most popular classes. Our resident authority on Social Security who teaches that class is with us today. David, please introduce our special guest.
Thank you, Chip. Yeah, so kicking off the new year here in week 2, we are having our first round of classes at the Midwest Learning Center. As we mentioned last week, there's going to be over 80 classes this year for educational content for you, our listening audience. But first up will be Social Security Blueprint, and that is taught by none other than our resident authority on the subject, great financial advisor, Sean Swanson. Sean, thank you for taking time to jump in here this morning.
Thank you very much, David.
I know you have a busy schedule, too, and you literally have like 10 minutes to spend with me because you've got appointments back-to-back today. So we'll just jump right in, Sean. It's 2024. There are some changes, obviously, with Social Security, as there are every year. So tell us kind of what's the big changes that you've seen, or at least 2024, income limits, those type of things. What's going on in Social Security land?
Well, first of all, I like to practice what I preach. So last night, I printed out my Social Security projection and my beloved wife's Social Security projection. David, as you know, my wife is already on Social Security, so her info looks different, and mine is for someone who's not taken it yet. Well, first thing I noticed is there's a 3.2% cost of living adjustment on either my scheduled payments or her actual payment.
Okay, let's pause that for a moment, because some people sometimes don't realize they get the COLAs prior to drawing. In other words, well, I want to turn, and we'll have someone say, we may recommend they wait till, say, 67 or even 70, depending on the case. But they're like, I just want to turn on now because I want to get that big COLA bump we had when we had an 8% bump 2 years ago, 5.9 last year. And so, I don't want to miss out. No, you get those, even waiting. So that's a really important distinction, number one. You still get the COLA bump in your estimate, and this year for 2024, it is
3.2%.
3.2%. So
that means
a good point.
That means if I looked at my statement and it said I was going to get $1,000 a month at whatever age I'm looking at, now it's $1,032 a month. That's how that COLA adjustment works. Of course, as you've taught us over the years, the inflation rate for many different things in our economy is way above that, so it doesn't necessarily keep up with all the spending that we've got to make.
Well, it's important, too, to point out, historically speaking, that is a better than average COLA bump. It's averaged 2.8% since inception. So we do get COLA bumps in Social Security but not every year. As we found out during 2010, 2011, 12, there was several years where we had zero COLA bumps because we had no inflation in the economy. So there's good and bad from it. But anyway, if you got a $3,000 Social Security estimate, then basically you got an extra $100 coming. So not
Absolutely.
too bad. All right.
The second thing that we noticed on the changes for Social Security is, unfortunately, the maximum taxable earnings level as
Oh, you mean I got to pay more taxes to get the same benefit? Yeah, that's right.
Yeah, it was around 160,000, but now if you're blessed to make, more than 168,000 bucks, the maximum taxable earnings is now $168,600. And what that means is if I made 200,000, the first 168,600 would be subject to Social Security. Then that remaining amount would not be. But still a healthy chunk, isn't it, David?
And there is proposals out there, just take that all the way up to 400,000. So for those that are blessed to have high incomes, I am such a person. That's the cap where I stop paying Social Security is at that 168,000. Now, just to give you some inflationary perspective, just 3 years ago that was 135,000 basically.
Wow.
So it's moved up quite. So that's an extra 30,000 of my income that I am paying Social Security tax, and I am the employer and the employee, so I'm paying the full 12.4%. So in the last 3 years, I've had a tax increase on about $40,000 a year, and my wife, by the way, is in the same boat. So we've got about $80,000 in new income that we'll have to pay, not new income to us, but new income that is susceptible to a 12.4% tax. So when people say, you don't understand taxes or pay your fair share, you might want to look at how the tax code really works. And of course, unfortunately, Sean, this is what penalizes so many seniors that are on fixed incomes and think they're going to be okay. They've got a pension. Maybe they were a teacher their whole life. They're getting a $40,000 or $50,000 pension income. They turn on Social 1, they turn on Social 2, then they take an RMD for their 403B because they're forced to take it. And all this makes all their Social Security have to pay income tax, which it doesn't have to be that way if you have enough time to plan ahead, right?
Ouch. Yes. And before I forget, let me make a little pitch here that Smart Social Security Blueprint class we're actually doing twice next week, David. Tuesday, January 9th and Wednesday, January 10th. They start at 6:30. And for more information on how to register for them, you can call our front desk number of 402-369-7777.
And these are one of the most popular classes, so you do have to register so we know how many bodies to expect. At, again, 6:30 at the Midwest Learning Center. Okay, so let's talk about now when people get their Social Security, or people that have already been on Social Security, sometimes around January or February, we get a few calls from clients. Hey, my Social Security just went down. It didn't go up. It went down, and it went down significantly. And sometimes they forget what choices they may have made in prior years, or they may have had additional income in prior years, especially the last year before retirement. A lot of folks get bonus income, or maybe they sell an asset as they're going into retirement to free up some liquidity. And no one's told people what this does to Social Security 2 years after the fact. So can you talk about, what I'm talking about now,
Yes,
that as one of 4 reasons why someone may actually have lower Social Security payments kicking in this year?
Yes. Yep. And if I could, I'm going to leave that one to last. The first most obvious reason why your Social Security would be lower than you thought is that you turned it on before full retirement age. Full retirement age for most people is between age 66 and 67. If you turn Social Security on at 62 or 63, your monthly amount is going to be lower. But then the other ones that people forget about is they may have forgotten that they have taxes withheld. So if they were expecting $1,000 a month, but they're having federal and state income taxes taken out, that's one of the reasons for the difference. Second one would be they're on Medicare. So if they're past age 65, their Medicare Part B premium, if they have Social Security turned on, is being taken out, and that has jumped this year to over $174 a month. Now that final one, we have a little nickname for that final thing. It's the Medicare penalty, but we call her Ugly Cousin Irma because you never want to go visit Ugly Cousin Irma. IRRMAA, IRRMAA, simply means for a single person or a married filing jointly couple, there's an income limit every single year. And David, if you're blessed to have more money than above that limit, that means that what you're going to pay for Medicare 2 years later is potentially going to be subject to a penalty. Well, when those penalties kick in January in your first Social Security payment, that can be a big scare. And there's several different reasons. You mentioned some of them, a big bonus from 2 years ago, or all sorts of reasons. But the good news is that Medicare penalty is not a permanent condition. Once it's triggered, if I trigger it for 2024 based on my earnings, that means that I'm going to have a penalty for all of 2026, but it's not permanent for the rest of my life.
Unless you don't make changes. And if the penalty were coming from sustained income, a la required minimum distributions. And that's where we see people that get blindsided by this. They have no idea that they're going to be forced to take money. They've done a great job saving. We see teachers walk in, railroad workers walk in, $800, $1 million, $1.2 million, $1.5 million in 401ks and 403bs because they've worked longer. They've worked a long time. They've been compounding these dollars and growing them. And all of a sudden they're like, well, I don't really need it, so I'll save it. And all of a sudden they get into their 70s and, oh, you have to take money out. And if you have a $1.5 million IRA or 401k, whatever the account is, you're basically having to take out almost $70,000 as a required minimum distribution. Now, that, if you're blessed with a pension or two pensions in the household, two Social Securities, and then you have to add that RMD on there, that pushes you not only into Aunt Irma or ugly cousin Irma, like you're used to that, to the penalty box, but it also typically puts you into a higher tax bracket. And so these are all the things that you cover in this class: how to understand the taxation of Social Security, what's going to happen to you now and in the future, and if you're blessed to be married in retirement, but you are unfortunately lose your spouse, and this is obviously, Mother Nature's undefeated here. This is going to happen at some point. The survivor spouse gets really hit based on the way the system is actually set up, and most people have no idea what's coming or how to prepare a plan for it. And this is the stuff that you cover in the class, right?
Absolutely. Yep. And it hits home. Just to tell a quick story, yesterday afternoon, I met with a lovely couple that was faced with this exact thing. Both of them had worked their backsides off to accumulate great wealth, and they also had a lot of guaranteed pensions. Well, what was going to happen was when they hit required minimum distribution age, not only were they going to be stuck triggering ugly cousin Irma the rest of their life, but David, that couple without any planning was going to be subject to the 33% tax bracket. And the guy stopped me right in the middle of the sentence and he said, whatever I need to do, don't make me go to the 30% tax bracket or higher. And I said, well, if we roll up our sleeves and work together, we can get this done.
And if you live here in the wonderful state of Nebraska, you can add another 6 and change on top of it. So you're almost at 40% raw tax bracket. When you're retired and you were told, remember that myth? Oh, you'll be in a lower tax bracket when you retire. And of course, that's just not the case or the reality for most retirees. Well, Sean, I promised to get you in and out of here. I know you've got a full schedule today. So I look forward to the first class of the year and hearing great results. Thank you for taking time to stop in the studio.
Thanks very much, David.
All right, Chip, what do we got next?
Up next, you have questions, David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. Well, David, this is perfect. You and Sean just had a pretty intense discussion about Irma, Aunt Irma, ugly cousin Irma. Irma took a beating last segment. We're going to look at it from sort of 30,000 feet here. Here's the question. My wife and I are both in our mid-60s and plan to keep working until 70. We are about to go on Medicare, and I'm trying to wrap my head around IRRMAA. IRRMAA. Can you summarize it? I'm especially interested in avoiding IRRMAA penalties. Well, let's define it again, and then go ahead, David.
So basically, it's your income-related monthly allowed allowance. In other words, the government puts you on allowance. You can't make too much money in retirement if you're going to access health care. And you can't, by the way, you can't opt out of Medicare, Chip, if you want your Social Security. It's a requirement, and a lot of people don't know that. You can't just say, never mind, I don't want it. Sorry, if you want to get the Social Security check, you've paid you have to sign up for Medicare. And Medicare, as we all know, is not free.
Well, hold on a second. Why is that? Why are they tied together like that?
Because they want to get this revenue we're about to talk about.
Okay.
This is how
All right.
This is a backdoor tax that was created so that they could tell you, oh, we didn't put any tax on there. Yes, you did. And it's quite significant. If we have a couple, Chip, that is about 65 years old today, a married couple, let's say they're both 65, and let's say they have saved $1 million in their IRAs, 401ks, whatever they are, and they're blessed to have some guaranteed income. Maybe they both were teachers and they have almost $100,000 in 2 pensions coming into the household. And then they also happen to have Social Security checks. So they're sitting with $160,000 of income going into retirement. Sounds great, right? Everything's hunky-dory. And they're like, we don't want to touch that IRA. We hear it all the time. Yeah, we just want you to grow this. We'll pick at it if we want to. Maybe our kids can get it. Well, if that dollar grows for, say, the next 8 to 10 years, depending on your age, and if you're 65 today, your RMD age is now 73. Okay, if you're born 1960 or later, so that'd be somebody 63. You don't take an RMD to your 75, by the way, now. So the rules have changed here recently. But if you keep deferring those dollars, so if you let those defer for another 8 years and you've got them invested, you could hypothetically double those dollars in that time period, right? So $1 million now becomes $2 million, which sounds awesome. Right? You've got $160,000 coming in guaranteed income from 4 guaranteed checks, 2 pension checks, 2 Social Securities, and you're getting some COLA adjustments on that. You're thinking life is great.
But Uncle Sam's going to want a piece of that action,
well,
isn't he?
So you're already paying 24% tax federally on that income, and 85% of your Social Security in that scenario would be taxed. But now, all of a sudden, when you're 73, you have a $2 million IRA. You're going to have to take out just a tick under $80,000 in year one of forced income called a required minimum distribution. Now you just jump to $250,000 in income. And oh, by the way, you are now in the 28% tax bracket where you're at 24 today, or 22 probably without the RMDs. So very big differences. And then just after a few years, those RMDs get bigger because as you get older, your life expectancy goes down. You'll be in the 32 or 33% tax bracket. 32 today, 33 here in 2 years when it flips back. So, and actually Sean talked about that 33% tax bracket. We show people and they have no idea this is coming. When you add the state tax on top of that, you could be paying close to 40% of your income to taxes, fed and state. And you're not making $1 million, Chip. You're not living on $500,000 a year. This is just from hard work, doing what you said you would do, saving, paying off your debts, doing the right things, and you get smacked by IRRMAA. So we have software we can run specifically for this. And I want to let anybody know, if you'd like us to run just the IRRMAA projections and what your lifetime spend on IRRMAA would be, we're happy to do that complimentary for you.
Boy, do not try to do it yourself, though. My God, whether it's us or somebody else, get some professional guidance when you're trying to navigate this minefield. All right, David, on to a question about taxes. In your offer for a tax guide, you mention tax loss harvesting. Please explain what that is and how you utilize it as a strategy.
So this would be pertaining to an account that you have to pay taxes on every year. So this is not an IRA or a Roth IRA or a 401k. This is what we call a non-qualified account. So this could be just an individual brokerage account or a joint account between a husband and wife or two people, whatever, or a revocable trust account. These are the accounts you have to stop and pay the tax man on every year. So let's just say you are blessed and you bought Apple several years ago, and it's risen, quite nicely here in the recent years. And so if you wanted to sell it, you would have to pay a capital gain on the difference from when you bought it to when you sold it. And that is what you pay, what's called a capital gain tax. Now, we currently have 3 different tax rates for capital gains. We won't get into all that today. And then depending on your income, you may pay a 4th tax or an additional tax on top of it called NIT, net investment tax. And that's either going to be 3.8% or 5%, depending on your income level, on top of the capital gain tax, which is going to be typically 15 or 20%. That's all federal tax, and state you pay 664 as well, at least in Nebraska. Now, confused? That's what we try to help people understand. So what we do, Chip, is for tax loss harvesting, if in your portfolio, let's just say you owned a healthcare stock like Pfizer, had its worst year ever last year. In the same portfolio of stocks, you've got all these large cap stocks, and Pfizer is negative, right? And you have a loss. So if you wanted to sell $100,000 worth of your Apple and maybe you had a $30,000 gain on that hypothetical sale, and if you have a $30,000 loss on the Pfizer position, you sell the Pfizer position with it, and pair the gain with the loss. Therefore, there's no tax that would need to be paid on that $30,000 gain, and you get to clean up your portfolio and get rid of something that may not be a favorable position in the current state of the economy and big pharma, et cetera. So that's just an example. So what we do is we help clients by automating this process and tax loss harvest out of positions. We can even go one step further and apply what's called direct indexing if it's a really big concentrated position. Like sometimes people will walk in, we've had clients walk in with several A shares of Berkshire Hathaway. They've held them for 30, 40 years, but now they have a lot of risk in a single company and they want to work their way out. So we can do something called direct indexing where we can tax loss harvest by adding a basket of 50 or 60 stocks and mirroring an index, typically the S&P 500, and buying and selling those stocks regularly and chipping away at the gain and minimal taxation issues to the client. So it's a way to de-risk a portfolio and pay lower taxes.
So I can use a loss in one place and apply that to a gain somewhere else to reduce the tax liability on the gain.
Now, the examples we just gave here are hypothetical, obviously, and we were talking basically just about stocks. This could be done with bonds. It could the gain here or the loss here could be paired with a gain or loss of an asset held outside of a traditional investment account.
Nice.
A rental property, a piece of farmland. So you have a gain there and you have a loss here. We can pair those together, and that's why you have to work with competent professionals that understand how the taxation of your accounts work, because it can add outperformance to your overall portfolio over time, sometimes as much as 2.69% according to Morningstar.
So make sure you optimize the flexibility that's available to you.
You can try and do this on your own and have at it if that's your flavor. But if you're going to be working with a professional, make sure they are versed in this type of strategy if you have a decent amount of dollars in non-qualified accounts. Great question, though.
David, we have time for one more question. This one's about IRAs and 401ks. My employer offers both a traditional IRA and a Roth 401k. From what I've heard you say about Roth, I probably should focus all of my employee contribution on the Roth 401k, right?
So typically that answer would be yes. For literally 9 out of 10 people we analyze, that is absolutely what I would typically recommend. Now, I can't make a recommendation not knowing all factors here, and income level, but it's not that difficult to understand. If you're in your working years, would you rather pay, and just so you know, we have a guaranteed tax rate hike coming in less than 24 months, right?
The Trump tax cuts run their course.
Tax and Job Act of 2017 is repealed at the end of 2025. So we have this year and next year. So you're going to be paying higher tax rates in the future. So why would you defer a tax today to take it out at a higher 3% or 4% higher rate? Every bracket goes up 3 or 4%.
Take the hit now.
In the future. For most people, it doesn't make sense. Yet we have accountants, CPAs, financial advisors that disagree with me, and I'm happy to debate somebody on these topics. We talked about this recently, but we run the math out, and so we're going to run this out for you. You can tell us, how long you think you're going to be here, how much you're going to save, how long you're going to work, and we can actually calculate and tell you exactly where it would be. Now, are there some occasions where we'd want you to put in the traditional? Absolutely. I have a doctor who's making almost $800,000 a year. We had this discussion just the end of last year. And he's a solo practitioner and he's got a solo 401k. And we actually deferred money into that account and knocked off a chunk off his taxable income for that year. Why? He's retiring this year. And his income is going to drop from well over $700,000 to all the way down to about $200,000. So he's going to go from a 37% tax bracket down to basically, because he's married, 24% tax bracket. So in that case, it would make sense. But most people that are just earning, dual incomes earning $80,000 to $150,000 a year and save up around $1 million or so, they are not going to a lower tax bracket in retirement. And we just want to run the data and show you these numbers so you can make an educated decision.
David, we're out of time for Q&A this week, but if people would like to take advantage of a discovery call about their retirement, how many openings do we have in the calendar?
We actually have 10 available this week. So
all right.
10 of these, this is where you get to spend 15 minutes with a licensed financial advisor. Ask them anything that you would like, your most pressing need. There's no obligation to do anything else with us. We just want to make sure you have the information to make good decisions.
10 sounds like a lot, but they fill up fast. 402-369-7777. No charge, no obligation. A discovery call with a question about your retirement with one of our licensed financial advisors. 402-369-7777. Up next, last week it was doom spending. This week it's the doom loop. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, it was doom spending last week, and this week, this is the headline from the federalistpapers.org. California doom loop continues. Mass exodus of the wealthy, leaving a fiscal crisis in their wake. Well, we've been on this topic for a better part of 2 years now, and it's not relenting.
Well, and you see the way some of the states are led and the direction they decide they want to go. And by the way, Minnesota is pushing to become worse than California. They're trying to push their capital gains tax for entrepreneurs to 16% state tax. You imagine? On top of the Fed tax you would pay. So that would mean, anyways, somebody had $1 million gain, they would pay 20% Fed. 5% net investment tax now, and then 16%. That'd be 41% in capital gains tax in Minnesota.
Minnesota, I almost think of like Venezuela. I mean, Minnesota for a long time was this great place. My wife spent many years in the Twin Cities. She went to college up there and lived up there and worked for Honeywell for a while up there. And just civically, economically, it is just a
Beautiful
great place.
State,
but
yeah.
now with the economics, the crime wave,
they've gone in a different direction. Let's just say that with the legislature. So they're and they seem to be copying the playbook of California. So to come back to the story you meant, the mass exodus. So and Gavin Newsom, the governor of California, who we know wants to ultimately be president, is out there trying to tell you how great it's been in California and all this. Well, their tax collections, Chip, are down 25% year over year because the earners that they keep just wanting to take more from, you cannot just tax your way to prosperity. And, we hear this, tax the rich, tax the rich. Well, you're not taxing the rich, you're taxing the entrepreneur that starts to invest his capital, makes money, hires more people. I'm a prime example of that right here. Okay. We had 2 more start this week, right? We've been a growing firm for 6 years in a row. We've added employees every year. And what does that do for the Omaha economy, right?
That's great.
People buy gasoline to drive here. They need cars to get here, right? They live in homes. They either pay rent or pay a mortgage. Somebody's paying property tax because that they go to the store and buy groceries and services. They pay tax on that. And so the economic velocity of money that is created when you create a new job is very impactful, and that's how you grow your economy. And California's not seen that literally since the Reagan days when he was governor way back when. And so California is in this doom loop where they just keep deciding to tax people more. The wealthier, they come up with creative now they're trying to push a wealth tax of 2% on people just on their net worth. How are you going to value that? How are you going to regulate that on farmland? And so you're seeing a mass exodus. And of course, there's the 3 Californias. There's a plan to split the state into 3 states and what have you. So this is just a shot across the bow to explain to people you can't tax your way to prosperity, just like you can't borrow your way to prosperity, right? So you need to have a plan to grow your way to prosperity, and that's with lower regulation and lower taxation. And we see the states that have done that have flourished in the last several years. We've talked about it, and lots of states are having incredible economic booms in the middle of these crazy times because they decided to be proactive. And even all the states surrounding us made some proactive moves in the last couple of years when we made some, but we're still so far behind. It's really bad.
Yeah. Well, and speaking of states making moves, Texas and California, Texas and Florida, Governor Newsom in California keeps taking shots at and picking fights with the governors of Texas and Florida, and they usually say, so by the way, all your former Californians who now live in my state, they said to say hello.
Especially
what he's doing. The most productive ones.
And obviously, there's different theories out there on what's going to happen. And obviously we have, and not to get too political, but we got Trump and Biden as the leading candidates, obviously at the moment. You're going to go through the primary season here starting very quickly. Right across the river here, Iowa caucus is coming up pretty quick. But they don't name the candidate till the conventions, and we'll be doing a lot more of this talk later. But I believe July or June is when the Republicans' convention is, but the Democrats don't have their convention until the middle of August, so they're not going to technically officially have their candidate until less than 60 days before the election. So think about that.
It sounds to me like you're not convinced that the incumbent president will be the candidate.
I don't think there's any chance he's going to be the one on the ticket.
Wow.
Almost zero chance.
Stay tuned for that one.
But anyway, we'll talk about that more in coming shows. We got a whole year to have fun with that one. So, but yeah, we're seeing this exodus and from states that overregulate and overtax. Period.
Hey, I saw this headline in Fox Business, and I thought of the recent conversation that you and financial advisor Brad Starkin had on our show about digital currency. The headline is Bitcoin soars past 45,000 for first time since April 2022. The article says that digital currency tends to perform well in election years. I didn't get the connection, but what is your take on all of this, David?
Well, it does, historically speaking, and again, the history on these is not that long, so we got to use that with some salt there. Just a couple election cycles, but it did go up, just like gold moved up, and that's typically as a store of value. However, I will tell you, since this article came out just this week, I believe it is on Wednesday, there was a story. I don't know if it was an actual story printed or just rumor on X, formerly Twitter, et cetera, running around that the SEC was going to deny all the ETFs, spot ETFs that were getting ready to launch. And Brad and I were talking about that, BlackRock, others. And so Bitcoin, all of them were down over 5% that morning. I don't know where they're at right now today. I don't watch it every day. But again, that just brings my point to make sure you understand the risk or the volatility of the assets you choose to own, especially when we're talking about not speculation capital, but your actual life savings, your retirement capital. You don't need to shoot for the moon. You need to have a plan that gives you a consistent, decent way to earn money, real rates of return, which is beating taxation and inflation consistently over a long period of time.
David, I ran across something in the Wall Street Journal that caught my eye because I thought, well, these are strategies that I hear David and our advisors talk about in presentations and use with our client base. The headline is 4 lucrative tax deductions that seniors often overlook. Well, let's see how the clock treats us, David. Maybe we can get through all 4 of these.
Sure. Well, so, we'll just talk about some strategies in general. So the article, which came out, I think sometime last year, was talking about, it had about a month ago. I think it was at the end of November. But it just talks about there are seniors that skip or miss, and this is unfortunately to self-filers. We actually had somebody just came in. They did their own return. They've done it for years and just don't want to pay a professional. And again, I always tell people, professionals get paid for a reason. They have some knowledge and skill typically. And again, not bashing people that do it yourself when it comes to taxes, legal work, or investing, what have you. But we believe you should always work with a competent professional because you may miss something. And one of the things that's missed is the extra deduction for being 65 years of age. It's $1,500 this past year per person, the biggest it's ever been. So if you're married, that was $3,000. And we do see it, Chip. It's not that often, but 1 or 2% of the tax returns of those over 65 miss that. A $3,000 deduction off your income. If you're retired and you're in the 12% federal tax bracket and another 6 or so for the state here, 18% on that $3,000. Hey,
that adds up.
It adds up. And so don't make the mistake of thinking doing your return yourself or using software that you're actually going to catch every opportunity. We think you should work with competent tax professionals. That's, of course, just our humble opinion. Now, one of the other things it talks about is understanding if you're still working, maybe you have a part-time job, you could actually make IRA contributions not only to your IRA, but to your spouse's IRA. And this counts for both IRA or Roth IRA. You have to have earned income to do it. But depending on how you do it, if your income is really low, you could use the traditional IRA. And if your income is under a threshold, Chip, there's actually a saver's credit. So you could put $2,000 in an IRA, Chip, and get a $1,000 tax credit. Credit, not deduction.
Right.
$1,000 tax credit. Now, it's very limited on how much income you can have, so it's not most of our clients we're talking about doing this with, but it is an actual strategy that could be utilized. Or if you have more than that and you've got earning, let's say, I've got a friend of mine that's a starter. He's retired, started a golf course here locally, right? He gets paid around $23,000, $24,000 a year. Well, that's enough income that he can contribute over $7,000 to his Roth and $7,000 to his wife's Roth. He could put $14,000 income into an account that will never get taxed again. And again, these are simple strategies you can look at to maybe institute at the end of the year. One of the other strategies in the article, Chip, was one of my favorites, QCDs. According to Ed Slott, he's America's CPA, if you don't know. He thinks this is the most underutilized tax strategy for seniors,
it's the
for boomers.
Qualified Charitable Distribution. distribution.
Correct. So you cannot do this from a 401k or 403b, only from an individual retirement account, an IRA specifically. But you can donate. So if you're tithing to your local church, let's just say you have retirement income of $100,000 and you're faithfully giving 10% to your church or any charity, but just in this example, we'll say it's a church. You're tithing that $10,000 a year and you're writing the check. And we see this all the time. People walk in 77 years old and we see on, I'm donating $10,000 to St. Vincent's or what have you, right? And they're giving that. Well, you could take that because the standard deduction is so big for a married couple seniors over $30,000. They're not itemizing that deduction, so they're not getting any write-off for it. They're blessing the church, which is great, or the charity. But with a QCD, a qualified charitable distribution, you could write the check from your IRA, and we do this for clients, hundreds of these every year, to the charity. You just can't touch the money. And then the distribution goes to the charity, and you do not have to pay tax on the distribution. Therefore, now you're getting the tax benefits because you'll never be taxed on the distribution, and you can actually eliminate your required minimum distributions with this, up to $100,000 of donations per year per IRA account owner.
Don't just retire smart, donate smart.
Yeah, absolutely. And we love that people might want to give, and so be smart about it. And the other thing is understand if you do have a lot of itemized deductions, you're using a Schedule A, and you can deduct your Medicare premiums. And a lot of people miss that as something that can be deducted. So there's a myriad of things. Again, you don't know what you don't know, which is why you need to get a tax analysis.
This is the kind of comprehensive planning we offer. We'd be glad to do it for you. Hey, last call for Smart Social Security Blueprint, Tuesday, January 9th or Wednesday, January 10th, 6:30 p.m., right here in the Midwest Learning Center at Retire Smart. 402-369-7777 to register. 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week and stay warm. The cold weather is back.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.